Not just yet, Wolf. Look, we have question marks about what the discount rate is. When interest rates go up, long duration stocks get hit the hardest, just like long bonds. That's exactly what's going on here. So it went up the most, the NASDAQ 100. It's come down the most. Then you add to that some earnings question marks, and that's why we've had such a hard time. You've got to be very selective in that part of the market, in my estimation.
But you do like one tech play. I guess it would be a value tech play, Intel, which didn't have a great quarter. Bob, why?
Correct. They did not have a great quarter. We like it. We think the long-term story there with a new CEO is promising. We find what they're doing with their cash wiser than what they've done in the past. The stock is reasonably cheap. And to your first point, our list of tech stocks that we own tend to be more of the old stories, the more value stocks, given the interest rate comment I made earlier, and less of the high PE newer tech stocks. They were the ones to own. Thankfully, we did, but we've switched in large measure.
Let's get your buy call on Lowe's as well.
Yeah, Lowe's, do-it-yourselfer, competition's Home Depot. They have more to go to raise their profit margins. They've been doing that now for several years. There is same-store sales, 2-3%. In this environment, that's pretty good. Recent management change. We think Lowe's is a good catch-up to Home Depot play.
Do you like any of the value sectors, or is it just stock-specific for you at this point?
Yes, our two favorite sectors in our 10 predictions for this year, financials and energy. Financials do well when the economy's doing okay, when interest rates go up, they're reasonably cheap, balance sheets in pretty good shape, and then, of course, the energy story. They're our favorite two sectors, and they're heavily value-related, as you know.
Well, they've both done very well this year. The only two positive sectors in the S&P, especially energy. Bob, thanks.